The real danger to the dollar isn't what the Federal Reserve says in public. It's what they refuse to say behind closed doors. For decades, the Federal Reserve has mastered the art of appearing transparent while revealing almost nothing of true importance. Press conferences, carefully worded statements, polished economic forecasts, all of it gives the impression of clarity and stability. But if you look closely, the gaps between words and actions have never been wider than they are today. And that gap is precisely where the real story of the dollar's vulnerability begins. The Federal Reserve insists that inflation is under control, that the economy remains resilient, and that the tools at their disposal are more than sufficient to manage whatever turbulence lies ahead. Yet internal documents, meeting minutes, and leaked discussions paint a completely different picture. Behind the polished facade is an institution wrestling with structural threats to the U.S. monetary system. Threats too large, too unpredictable, and too politically explosive to admit publicly. One of the clearest signs is the way the Fed communicates risk. When danger is minor, the language is direct. But when the danger is existential, the language becomes vague, abstract, and filled with conditional statements. Over the past 2 years, their messaging has shifted almost entirely into this ambiguous zone. Instead of clarity, we get phrases like data-dependent, considerable uncertainty, and monitoring imbalances. These expressions are not reassurances. They are warnings disguised as caution. Another red flag lies in the mismatch between the Fed's public strategy and its secretive emergency operations. Quiet liquidity injections, sudden adjustments to overnight lending facilities, experimental balance sheet maneuvers. None of these appear in headlines, but they reveal a system under stress. When the Fed says everything is fine, yet simultaneously expands backdoor liquidity programs, the contradiction becomes impossible to ignore. Something is wrong, and the institution is buying time. Even more unsettling is how the Fed discusses long-term fiscal conditions. Officially, they avoid criticizing government spending or debt levels. Unofficially, internal meetings reveal growing fear about the trajectory of the U.S. deficit and the rising cost of servicing that debt. The Fed knows the truth. When a currency is backed by confidence, any erosion of that confidence becomes a threat to the currency itself. And the confidence behind the dollar has never been more fragile. The Fed also avoids discussing international de-dollarization efforts. While they publicly downplay the significance of countries reducing their reliance on the dollar, internal assessments show a much deeper concern. The shift may be slow, but it is real, and over time it will weaken the very foundation of the dollar's global dominance. Admitting this openly would trigger panic, so they say nothing. All of this creates a dangerous illusion. On the surface, the Fed presents a world of stability and control. Beneath the surface, the institution is fighting to maintain credibility in an environment where the slightest policy error could trigger a chain reaction. And because the dollar sits at the center of the global financial system, any miscalculation affects not only the United States, but every economy tied to it. The Fed isn't lying, not directly, but they are withholding the truth, revealing only what the public is prepared to hear. And the silence surrounding their most difficult decisions may be the biggest warning sign of all. The biggest threat to the dollar isn't foreign competitors. It's the mathematical reality the U.S. can no longer outrun. For decades, the strength of the U.S. dollar rested on a simple assumption, that America could always grow faster than its debt. This belief created confidence, and confidence created demand for the dollar across the world. But today that assumption is collapsing, and with it the structural foundation that has supported the global financial system for nearly a century. The United States has entered a debt trap, a cycle in which borrowing grows faster than the economy can sustain, and the cost of servicing that debt accelerates uncontrollably. The numbers are staggering. Trillions added every year. Interest payments rising faster than national defense spending. Debt to GDP ratios blowing past the thresholds that economists once considered danger zones. The government keeps borrowing because it must, not because it chooses to. And the Federal Reserve is forced to manage the consequences of a system that is beginning to tear itself apart. The trap works like this. When interest rates were near zero, debt was cheap. Borrowing felt harmless. But when inflation surged and the Fed raised rates to cool the economy, the cost of that debt exploded. Suddenly, The government must spend more and more money just to pay interest on past borrowing. This creates a self-feeding spiral. Higher debt requires higher interest payments, which require more borrowing, which creates even more debt. The math becomes impossible to escape. The danger is not that America will run out of money. The real danger is that investors, both domestic and global, will lose trust in the long-term stability of U.S. finances. Confidence is the invisible glue that holds the dollar system together. Without it, the dollar becomes just another currency, and treasury bonds, once considered the safest asset in the world, become instruments of risk instead of refuge. The Federal Reserve understands this risk better than anyone. It sees the projections. It knows the trajectory. It knows that the economy cannot withstand both high interest rates and a soaring national debt indefinitely. Something has to give. Either the Fed cuts rates prematurely and risks reigniting inflation, or it keeps rates too high for too long and pushes the debt system toward collapse. Every decision tightens the trap. There is another layer to the crisis. Foreign demand for U.S. debt is weakening. Countries that once relied on the dollar for reserves are diversifying. They are buying gold at record levels, forming new trade blocs, and building alternative payment systems. This does not destroy the dollar overnight, but it erodes the margins of safety that once made the dollar untouchable. The Fed cannot publicly admit this erosion, but it must quietly plan around it. The final fracture is domestic. As debt rises, the government will face pressure to monetize it, a polite phrase meaning print money to pay bills. This is the ultimate danger zone. Monetization destroys trust, weakens purchasing power, pushes inflation higher, and signals to the world that the U.S. has crossed a line it cannot uncross. The Fed knows that once confidence breaks, no policy tool can fully restore it. In this environment, the dollar's stability depends less on economic fundamentals and more on the ability of policymakers to maintain a delicate illusion of control. But illusions fade, and when they fade, the consequences do not come gradually, they come suddenly. The cracks in the dollar system are not abstract theories. They are the mathematical reality of a nation spending more than it earns, borrowing more than it can repay, and relying on a financial architecture no longer designed for the pressures of the modern world. The dollar won't collapse in a single moment. It will erode slowly, as the world quietly builds a future where it is no longer needed. For decades, the U.S. dollar sat at the center of global finance, not because countries loved America, but because they had no better alternative. The dollar was liquid, stable, and backed by the world's deepest financial markets. But the world is changing, and for the first time since the end of World War II, major nations are taking deliberate steps to reduce their dependency on the dollar. They are not doing it loudly. They are doing it quietly, strategically, and with long-term intent. The shift began subtly. Countries started reducing the percentage of dollars in their foreign exchange reserves. It wasn't dramatic at first, a few percentage points here, a few there, but the trend became unmistakable. Over a decade, global dollar reserves dropped to levels not seen in 30 years. Nations are diversifying not because they believe the dollar will vanish, but because they no longer trust it as a single point of failure. At the heart of this movement is a geopolitical calculation. Many countries have watched the United States weaponize the dollar through sanctions, asset freezes, and financial restrictions. The message was clear. If you anger Washington, access to the global financial system can disappear overnight. For some nations, this risk became intolerable. So they began building alternatives, trade agreements, currency swap lines, regional payment systems, and bilateral contracts that bypassed the dollar entirely. One of the most symbolic shifts is the rise of gold as a reserve asset. Central banks are buying gold at the fastest pace in half a century. Gold provides no yield, no income, no dividends. Yet nations are choosing it for one reason. It cannot be printed, frozen, or sanctioned. Gold is not a replacement for the dollar, but it is insurance against it. The more uncertain the global landscape becomes, the more appealing that insurance looks. Another key development is the expansion of BRICS and other economic alliances exploring shared payment systems. These systems are not as advanced or liquid as the dollar-based infrastructure, but they don't need to be, not yet. Their purpose is strategic, not immediate, to slowly reduce exposure, to build resilience, and to create leverage against the U.S.-dominated system. For the first time, the financial world is experimenting with a multipolar structure. Trade patterns are shifting as well. Countries like China, Russia, India, Brazil, and Middle Eastern states are conducting more transactions in local currencies. The amounts are still small compared to the global dollar flow, but the trend line is unmistakable. What begins as 1% becomes 3%, then 7%, then 15%. Dollar dominance does not disappear through collapse. It disappears through erosion. The Federal Reserve understands all this, but it cannot publicly acknowledge the decline. Doing so would accelerate the process. Instead, the official line remains unchanged. The dollar is strong, stable, and irreplaceable. But behind the scenes, policymakers are watching closely because they know that reserve currencies do not last forever. History is clear. From Rome's silver denarius to Britain's pound sterling, global monetary leadership is temporary, not permanent. The world is not abandoning the dollar out of hostility. It is preparing for a future where relying on a single currency is too dangerous. And the more unpredictable the U.S. becomes economically and politically, the stronger the incentives become to create alternatives. The dollar's decline will not be sudden or dramatic. It will be slow, quiet, and disguised as diversification. But once trust erodes, it rarely returns to its previous strength. The global financial order is being rebuilt in silence, and the dollar's central role in that order is no longer guaranteed. The Federal Reserve isn't fighting the crisis. It's experimenting with tools so risky that a single miscalculation could shake the entire dollar system. Behind closed doors, far from press conferences and public speeches, the Federal Reserve is running a series of quiet experiments, emergency tools, hidden liquidity channels, and monetary mechanisms that were never meant to become permanent. These tools were originally created to stabilize markets during extreme shocks, but now they are being used routinely, almost casually, and that shift reveals something the Fed cannot say openly. The system is no longer stable on its own. One of the most alarming tools is the network of emergency liquidity programs that operate in the shadows of the financial system. Overnight lending facilities, standing repo windows, and swap lines with foreign central banks are all designed to keep markets functioning when confidence evaporates. But the fact that these programs must remain active even in normal times suggests that stress is building beneath the surface. Liquidity has become a crutch, and the more the system relies on it, the weaker it becomes. Another silent experiment involves the Fed's balance sheet. Officially, the Fed has been trying to unwind the massive asset purchases from previous crises. Unofficially, the balance sheet remains historically large, and sudden spikes in holdings reveal hidden market interventions. These interventions are not publicly announced, but they show up as small irregularities in weekly reports, clues that the Fed is buying more than it admits, propping up areas of the economy that are already under strain. But the most controversial experiment is the quiet push toward a central bank digital currency, CBDC. Publicly, the Fed insists that it is merely exploring possibilities. Privately, research programs, pilot tests, and infrastructure development are accelerating. A digital dollar would give the Fed unprecedented control over the financial system, the ability to track transactions, freeze assets, impose negative interest rates, or distribute stimulus directly. For the Fed, this is a tool to stabilize the system. For critics, it is a step toward a monetary architecture built on surveillance and centralized power. Another tool is far less visible but far more dangerous: inflation as policy. The Fed will never admit this, but allowing inflation to run higher than target is one of the oldest tricks in debt management. Inflation erodes the real value of government debt, making it easier to repay. In other words, inflation becomes a hidden tax, one that the public never votes for and cannot avoid. If pushed too far, this tool destroys trust in the currency itself. There is also the experimental use of yield curve manipulation. The Fed publicly controls short-term rates, but behind the scenes it influences long-term rates through targeted asset purchases and carefully timed public statements. When a central bank controls both ends of the curve, markets are no longer markets. They are simulations, delicate constructs that survive only as long as the illusion holds. The greatest danger is not the tools themselves, but the fact that the Fed is using several of them simultaneously. Each was designed for emergencies, not for everyday conditions. When combined, they create unpredictable feedback loops that even the Fed cannot fully model. The system becomes increasingly fragile, like a machine kept running by improvised repairs instead of true maintenance. The Fed believes it can manage these tools with precision. But history shows that complex systems rarely fail gradually. They fail suddenly, from one flaw that interacts with another in an unexpected way. If the Fed's experiment goes wrong, the consequences could extend far beyond inflation or recession. It could trigger a fundamental loss of confidence in the dollar, a crisis not of economics, but of trust. If the Federal Reserve miscalculates even once, the fallout won't stop at the markets. It will ripple through every corner of the American economy. The Federal Reserve's tools are powerful, but they are also blunt. If its ongoing experiment with liquidity injections, rate manipulation, digital currency pilots, and inflation engineering spirals out of control, the consequences will be far more severe than a typical recession. The structure of the U.S. economy is so intertwined with the dollar system that any shock to the currency triggers a chain reaction that spreads instantly through businesses, households, and global markets. The first and most immediate impact would be a collapse in confidence. Confidence is the invisible foundation of the dollar, more important than supply, demand, or interest rates. If investors begin to doubt the stability of the currency, they will flee into safer assets such as gold, commodities, and foreign currencies. This flight to safety would cause Treasury yields to spike, raising borrowing costs for the government, corporations, and consumers at the worst possible moment. Higher borrowing costs would hit businesses next. Companies already struggling under record levels of corporate debt would face a refinancing crisis. Many would be unable to roll over existing loans, triggering a wave of bankruptcies. Small businesses would be the first to fall, followed by heavily leveraged giants, especially in sectors like real estate, technology, and private equity. What begins as a financial problem quickly becomes an employment crisis. Banks would be pulled into the turmoil almost immediately. As defaults rise and asset values drop, their balance sheets would weaken. Regional banks, already shaken by recent instability, would be especially vulnerable. A few strategic failures could spark panic, leading to bank runs or forced consolidations. To stop the bleeding, the Fed would have to intervene again, but doing so could worsen the loss of trust it was already trying to contain. Consumers would feel the shock through rapid declines in purchasing power. If the dollar weakens domestically or internationally, imports become more expensive, inflation accelerates, and wages fail to keep up. Everyday necessities, food, energy, housing, would rise in price even as economic activity slows. This is the nightmare scenario, stagflation, where inflation remains high while growth collapses. The last time the U.S. experienced this was the 1970s, but the scale today would be far greater. Another layer of crisis would unfold in the real estate market. Commercial real estate is already under pressure from rising rates and declining occupancy. A sharp tightening in credit would accelerate loan defaults and force distressed sales. Residential markets would fracture as mortgages become more expensive and households lose financial stability. Housing, traditionally one of the strongest anchors of American wealth, would no longer feel safe. On a global scale, the consequences would be enormous. Countries that hold U.S. treasuries as reserves would face losses, pushing them to diversify faster. Nations dependent on dollar trade would struggle with volatility. Competitors like China and BRICS nations would use the moment to accelerate their own financial systems, further weakening the dollar's influence. But perhaps the most important impact is psychological. A failure of the Fed's experiments would shatter the belief that the U.S. financial system is self-correcting and unbreakable. When belief collapses, systems collapse. And rebuilding trust takes far longer than rebuilding balance sheets. The Fed is playing a high-risk game because it believes it has no better option. But if the experiment fails, the shockwave will not simply shake markets. It will rewrite the American economic landscape for a generation. A crisis in the dollar system doesn't start on Wall Street. It ends in the lives of ordinary people. When people hear about the Federal Reserve, debt traps, liquidity crises, and global de-dollarization, they assume these are distant problems. Abstract, technical, something for economists and bankers to worry about. But the truth is far more unsettling. If the dollar system destabilizes, the impact will hit everyday citizens faster and harder than anyone expects. And unlike investors or corporations, most people have no protection at all. The first and most immediate change will be in the real value of money. If the dollar weakens, inflation will rise not gradually, but suddenly. Prices for basic goods, food, gasoline, rent, utilities, will climb faster than wages can adjust. Even a small decline in the dollar's purchasing power can erase years of savings in a matter of months. People will feel poorer without understanding why, because inflation steals quietly. You don't lose money, your money simply buys less. Next comes the issue of credit. The U.S. economy is built on affordable borrowing, mortgages, car loans, business credit, student loans. But if the system enters a crisis, interest rates could spike dramatically. Mortgages would become unaffordable. Credit card debt, already at record highs, would explode under higher rates. Many families would no longer qualify for loans, and those who do will pay 2 or 3 times more than before. A credit squeeze doesn't just slow the economy, it chokes it. Jobs would be another casualty. When businesses struggle with higher borrowing costs and falling demand, layoffs always follow. Sectors like technology, retail, manufacturing, transportation, and real estate would be hit first. Even companies that are financially healthy would cut costs to survive the uncertainty. Job stability, something generations have taken for granted, would become rare. Meanwhile, the cost of living would continue rising. The housing market, long seen as the safest store of value for American families, would face its own crisis. Not a crash like 2008, but something more complicated. Mortgage rates rising sharply would freeze buying activity. Sellers wouldn't want to accept lower prices, buyers wouldn't be able to afford higher rates, and the market would enter a painful stalemate. Home values might fall in some regions while affordability collapses nationwide. Families counting on home equity as their financial cushion would find the cushion thinner than they expected. Savings, one of the fundamental pillars of personal financial security, would also be at risk. Traditional savings accounts already lose value during inflation, but a dollar crisis would accelerate the erosion. People who worked for years to save responsibly would watch their financial safety nets shrink. The emotional toll of seeing responsible behavior punished is often overlooked, yet it shapes how societies respond to crises. One of the most overlooked dangers is the psychological shift that occurs when a currency weakens. People begin to lose trust in institutions. They change their spending habits. They panic buy, hoard, or withdraw cash. Social stress increases. A currency is more than paper or digital code. It is a shared belief system. Once the belief weakens, daily life becomes unpredictable. Stability disappears not because anything dramatic happens, but because people no longer feel secure. But the consequences are not only negative. Periods of monetary turmoil also expose the importance of financial awareness, something many people ignore during calm times. Those who understand how money works will make decisions that protect them, reducing debt, diversifying assets, holding inflation-resistant stores of value, investing in skills that remain valuable in any economy. Crises reward the prepared. The most important lesson is this: the dollar system does not need to collapse for life to change dramatically. It only needs to wobble. A shift in confidence, a spike in inflation, a sudden credit freeze, or policy mistakes at the Federal Reserve can reshape everyday life long before any headline announces a crisis. Ordinary people will feel the impact first, and for many, it will feel like the ground is moving beneath their feet.